We're going to be talking now about bringing crypto custody and exchange and execution to the next generation of fintechs, and we'll have 3 chairs. Thank you. And we're going to call up Stephanie Ramezan and Liliana Reasor for the stage. So we're going to kick it off. Welcome.
Thank you.
Oh, thank you.
Awesome. So we'll kick it off, asking a little bit about each of you, your roles, how you guys came up to the industry and such. So what's your story, Stephanie?
What's my story? So, like many people now in crypto, started my career in traditional financial services many moons ago, and Bitcoin, crypto didn't exist back then. And then in 2018, I made the transition from traditional financial services into one of the first banking startups in London, which was building to service corporates in the crypto sector. And that was very much a baptism of fire for me. I think they say that crypto years are like dog years, so every year is worth about 7 in real life. And I definitely learned more in that first year than I had done for a very long time, which is partly how I got the bug to go deeper down that rabbit hole. And about 18 months ago, I joined Gemini, which is the crypto exchange and custodian, which was founded by Tyler and Cameron Winklevoss back in 2014 in New York. The Winkleviers, they're collectively known, relatively infamous for their debacle with Mr. Mark Zuckerberg over Facebook. And they bought heavily into Bitcoin back in 2013 and realized there wasn't a custodian that they felt was regulated, safe, secure enough for them to feel comfortable depositing their personal assets. So they went about building Gemini. And we started in the US, then we built out into the UK, Singapore. Most recently, we've just got our license through the Central Bank of Ireland, and we'll be forging further into Europe.
Love that. Good. Liliana, what's your story?
So I come as well from a traditional finance background with 20 years experience in all areas of finance, like investment banking, trading, from the likes of JP Morgan, Bank of America, Deutsche Bank, Morgan Stanley, Moody's Analytics. And I got into crypto because I thought crypto will be changing the financial markets, capital raising, and everything to do with finance. I will be one of the new categories within fintech, or the most cutting edge subsectors of fintech. And I thought, with so many cryptocurrencies trading globally everywhere and being created daily all of the time, that there will be a need for someone to think of the investment and risk intelligence for those cryptocurrencies through investment risk models that could analyze them and categorize them based on the risk. And so I created SupraFin, which first launched the SupraFin app in the US, some sort of robo-advisor for cryptocurrencies, which was integrated with Gemini to be able to launch there. And subsequently, now we're expanding into B2B to offer other things like crypto investment risk scores.
Nice. So in the context of this panel, we're going to talk about custody. We spoke a little bit about non-custody or self-custody early on today. So can you guys help us understand a little bit, what is crypto custody in essence, and how does that play a role in fintechs coming into the crypto space?
So custody can be split into different categories, and there are various different technologies around crypto custody that do exist. Depending on the specific client, their use case, and their priorities, they may opt for one or the other. So in very basic terms, a lot of people have heard of the hot wallet and the cold wallet. So your hot wallet will be on an exchange, always connected to a network, so that would usually be the fastest way to trade your balances. And then there's also the cold wallet, and with Gemini, we have cold segregated storage. So this is custody on HSM modules, which will never ever be connected to the internet, to a network. So that will be the safest way to store your crypto. Of course, that may be a little bit cumbersome. This is not going to be necessarily the best option for, say, a high-frequency crypto fund that's constantly trading in and out. There is something that would perhaps slot what you might say more into the middle, MPC technology, which effectively gives you the accessibility of a hot wallet, but closer to the security of a cold wallet. And that's something that we're also integrating into Gemini.
Interesting. And how does that play a part in building a fintech of the next generation?
Well, for SupraFin, being the investment management layer, we need to rely, for the B2C market as an app, we need to rely on good and excellent custodian for those cryptocurrencies that get purchased, and an excellent, as well, crypto trading company, so crypto trading custodian. The custody is extremely important because we don't want clients to lose those cryptocurrencies, either through hacking or errors, or after, obviously we've known of all the hacks that are happening in cryptocurrencies. Many exchanges have had those issues, and for us it was very important to just have a reliable partner for the custody. I think custody is extremely important.
Got it. And I understand reliability, but what would be, say, the top 3 or 5 items and criteria to select a crypto custodian as a partner? Because I know that there are many crypto custodians in this space now. They provide different types of services, different levels of services, and they have different choices in infrastructure. So how do you go about selecting one that kind of, not exactly the why, but what is the criteria?
Number one is it
apply?
needs to comply with the regulations of the particular country where you need to launch. When we chose Gemini to launch in the US, obviously they were fully regulated and comply with all the laws. Otherwise, we couldn't launch. So number one criteria, and also Gemini was the first regulated custodian exchange in the UK. So that was another important criteria for us. And then other things that matter is the coverage. So if you have a custodian that only covers 1 or 2 cryptocurrencies, then that's not very relevant, at least for us, because we were a platform that selects cryptocurrencies from a large universe. So that was the other thing, is like, do they cover within all their cryptocurrency universe, cryptocurrencies we might want to select. The other, it will be global presence, so that if we want to expand, that they are everywhere. And then reputation, that they've never had a hack, because I think that to us matter as well. Yeah, many things, and for us, Gemini tick all those boxes.
Got it.
And I think to add to that, one thing, it was actually a really unfortunate event for certain people, but in certain crises, people can then better communicate their own messaging and what the differentiators are and USPs between players. And a couple of months ago, there was an article in the FT where, I can say their name, Coinbase had to admit to their customers if, God forbid they were to go insolvent, then they would not necessarily be returning their assets to their customers. And this, that's obviously a pretty big piece of news. And quite rightly, Liliana wrote to me, copy of the article, is this the same for Gemini? And we are very, very proud to say and happy to say, because of our structure, because of our regulatory status, it is absolutely not the case. The way that we have been structured and set up, we're a New York trust company. We have the same capital reserve requirements that go to any other regulated financial services company within New York or globally. So, hopefully that would never happen. But if in the very worst case scenario, because of our structure, we don't have that same debtor-creditor structure, those assets would be returned to customers by the regulators. And I think that gives comfort not only to the first-degree client like Liliana, but when, say, she's looking for investment, when she's going to her VCs or her angels and saying, well, why are you choosing that particular partner? Yes, we tick the box for her own business needs, but beyond that, she's thinking ahead to make sure that every base is covered in terms of client protection as well.
Interesting. And it's the legal entity construct more so than the actual technology or anything that actually prevents any trickle-down effect should something like this happen. Which kind of segues a little bit into my next question, which is, when you're a banker, a traditional banker, and you hear custody, there's an image of custody that we project like, oh, okay, so it's like securities custody or bonds custody and all of that, thousands of people running around with the papers and the PDFs and all of that. And that is an image that we kind of, when you think about custody, that's what comes. And then crypto custody is super far from that, because it's more on the space of information security and degrees of certification in terms of the premises, the hardware, the technology, the cryptography. So can you explain a little bit, for the non-initiated, how different these things are and why those things matter?
Absolutely. So going back to, if you look at the cross-section of crypto exchanges out there, we're all battling for customers, and security has to lead from our perspective. When Gemini was built, we effectively overly regulated ourselves. Even though it was crypto, we didn't necessarily need to, because we saw this day that's already upon us, really, where regulation is being more and more scrutinized, security is becoming more important. So we've structured ourselves, as previously mentioned, in terms of just those legalities. But in terms of the actual technology, we wanted to make sure that our exchange is as safe as possible. Now, what has that meant? Maybe it's meant that we've been a little bit slower in terms of customer acquisition, because we have chosen not to operate in jurisdictions where we're not regulated. It's meant that we have been a little narrower in terms of the tokens that we would actually custody. We're adding tokens sort of every 4 to 6 weeks. We're currently listing and doing custody for perhaps around 100, but there are players out there that might be doing 200, 1,000. I mean, there are 19,500 and something cryptocurrencies out there, which is pretty mind-blowing. Obviously, we need to get rid of 19,000 and something of them, and that will happen, I'm sure, very, very soon. But that technology, going back to your question, that has always been at the forefront as well. So with our exchange technology, when it comes to custody and our hot wallet, we have proprietary algorithms that are constantly sweeping assets off the exchange. We also have insurance for the exchange and for the cold storage. But what we are always trying to endeavor is that there are never any more assets on exchange than that we can be comfortable with in terms of our security, our risk profile, our insurance policies. So we're constantly sweeping off of hot into cold. And then, as mentioned, we have the clients who are opting in for that cold segregated, which are never on network anyway.
Yeah, and I guess to add to that, you brought up the insurance. So while obviously technically your custody solution is very good, in addition, having the insurance, that's something that we thought, oh, fantastic. You guys have insurance against hacking, and that gave us more assurance that our clients' cryptocurrencies will be safe.
Got it. So in your perspective, Liliana, what are the challenges to actually go in and find the partner and then implement with that partner? What is the path for adoption in that sequence?
Partner for within custodies,
yes.
Correct? Challenges. Well, obviously, a lot of exchanges custodians are not properly regulated, and that was a challenge until, again, Gemini came into the picture in the UK. Because we have previous partners, we wanted to launch with them, and regulation changed in the UK especially, and they were not properly regulated, and so we couldn't launch, even though we had already integrated with their solution technically. So that was a challenge, finding the right partners with global presence that are properly regulated, that haven't had any scandals of hacks, and also where the owners of those companies have the right understanding of what it is to serve their client base, instead of being an entrepreneur that is trying just to make the most money for themselves without caring about the clients. That to us also was important. So who owns Gemini, and that added a lot of value for us.
And in terms of running the custody business, I mean, we have a question from the audience that's, what are the biggest risks associated with crypto custodianship apart from hacking? What are the other risks that you have to manage on a regular basis?
Risk around custody, well, of course, apart from hacking, there's just general technological risk, making sure that your APIs are what your actual customers need. Technology is changing all the time. We've built our APIs for a plethora of clients, whether that be a traditional bank or whether it be a startup fintech like Liliana's. We have Fix and Rest. So for those slightly more techie people in the audience, you'll know what that is. And In terms of other risks, I'd say it's just about managing that client relationship as well. Gemini is not a business where it's just, as Liliana says, let's just make the most money. And especially in a time where we are now, we don't want to be obsessed with prices. We don't want to be obsessed with what our other peers are doing. We should be conscious of it. But this is about building the right products that our clients actually need and making sure that they're fit for purpose. So I think a risk with any custodian is that they just get fixed on one end game or one end goal, and the market's constantly changing. And when you start building, things may look very different by the time you finish building. So it's about being agile and making sure you're listening to customers, you're paying attention to regulations on a global scale, because from a jurisdictional perspective, what we need to provide to a customer for exchange custody in one country may be different from another. But it's about making sure that that foundation is strong and that it's robust.
Interesting. There's also a liquidity component when you're the custodian. You have to have the immediate availability of assets. And there's a question from the audience that how does the risk models vary for crypto compared to traditional assets? We're seeing the emergence of this new asset class. It has potentially characteristics of all the other asset classes plus the programmability. So how do you manage that in the context of the custodianship?
Well, I think it's important to differentiate that. When I personally say custodian, when Gemini says custodian, we are there as a virtual piggy bank to keep your assets safe. And if you are opting in for cold storage custody or you're on exchange, they are your assets. There are obviously companies out there that take your assets, and people may incorrectly call them a custodian, but they are rehypothecating your assets, or you are lending your assets. I mean, there have been obviously the obvious episodic bankruptcies in the market. Let's look at Terra Luna. A lot of people got into Terra Luna not understanding, number one, they were even in crypto, or perhaps mistakenly thinking they're giving their assets to a custodian. That was obviously not what was happening. And that can obviously lead us, segue, haven't got time today to go into the point of stable coins and throwing that term around stable coins. They're not all created equal. Gemini do have a stable coin, GUSD, and that is a true stable coin. It's backed one-to-one by the US dollar, by real assets that are kept in a physical vault where the physical cash is there, that is independently audited by KPMG or equivalent every single month. So our risks are actually much more mirrored to the traditional financial services world. And I think for people who are just coming into crypto, especially in the retail markets, this is why regulation needs to gain clarity ASAP. So education is key to that, to make sure that it's actually the consumer who understands the risks and the risk around what they're actually engaging in. If you're engaging with a crypto custodian, it's just about regulation, it's about structure, it's about, Liliana says, reputation, and what that business is, and making sure that you're really differentiating between a custodian and a borrower.
Got it.
And just to add that, so we specialize, SupraFin specializes in risk, and I come from that background. I work for Morgan Stanley, the risk portfolio group. And so to answer the question, how are risk from cryptocurrencies different from traditional assets? They are different and similar. For stable coins, they are a bit similar because all of those have collateral. So you could think of it as a structured product, and you need to analyze the collateral. For exchange tokens, those are cryptocurrencies that are native to native blockchains like Bitcoin, Ethereum, Litecoin. There's hundreds of those. That's a very different model. It's not about cash flow, but it's rather how that cryptocurrency incentivizes the miners or people performing the proof, doing the validation, like proof of stake, and how that secures the entire network, because those blockchains are payment networks. And so that's a very different model. And then there's whatever cryptocurrency it is going to have a model and some factors that drive the riskiness of that. And it's understanding that complexity and how it all works.
Got it. So we're out of time. Great conversation. Thank you so much. And we're going to continue.
Excellent.
Thanks.
Thank you.
Thank you.
Thank you.